Hello and welcome to another episode of Trust Issues. Today I'm sitting down with Jean Roche, manager of Schroder UK Mid Cap, to talk about the fund and the opportunities for investors in the UK mid cap sector. Jean, thank you very much for joining us today.
Delighted to be here. Didn't have to come too far.
No, absolutely. So if we can start off with the big picture, we've seen a lot of change this year with investors starting to look finally beyond the S&P 500.
Mm-hmm.
Do you think now is a good time to invest in UK mid caps, and what opportunities do they offer relative to smaller and larger caps?
Yes, I think the time is now really for UK mid caps, and we've actually seen a small re-rating upwards of UK mid caps. They're still on a discount to the large caps, but there are a few elements as to why I think there's a little bit of budding interest in UK mid caps, which is good to see. That is that the rate cutting cycle has started and seems likely to continue, although we're all sort of watching the Bank of England's body language very carefully, and the whole market is drawing different conclusions on that. The valuation is supportive still, less than 12 times earnings for UK mid caps, and we're looking at earnings growth forecasts of around 16% for the mid caps as a whole. So doing the maths really quickly in your head, that's a peg of about 0.75, 0.8.
Very good.
Meanwhile, I'll give myself a bonus reason. We have not one, not two, but three trade deals, which isn't unhelpful, I think, for sentiment generally. And you asked about relative to large and small caps. Well, I'll state the obvious first, which is that with UK mid caps, you get more domestic exposure than you do with large caps. I mean, part of the reason that large caps had done so well, say to the end of March, was that people didn't necessarily want UK domestic exposure. But now I think they're thinking it might be safe to come out. And equally, you can have it both ways, though, with mid-caps, I hasten to add. If you want to lean more into international, you can, because 55% of revenues come from international sources and 45% from UK sources. So you can lean either way. But if you're looking for something that's quite UK domestic, it's a good place to look, UK mid-caps. And we see pockets of value within the domestic sectors here, and a government with the mandate and, it would seem, the will to change the status quo, for example, on planning. I wouldn't call it exactly a war on the NIMBYs, but I think there's an understanding now that stuff needs to get built. So with that backing, there are some sectors that had been sort of seen as dead and buried that are now coming back to life. So, for example, the brick companies or the adjacencies to the house building sector, RMI, for example, suddenly everybody wants to do DIY again, obviously having been sick to death of it 5 years ago. And then relative to, say, the small caps, there's a sweet spot in the development stage of a company where it's more practiced at communicating with the market. So, when you look at small caps versus mid caps, it's very important to guide the market well. And I think mid-cap companies are at that point where they're still growing really nicely, growing more than large caps are, but at the point where they have got used to communicating with the market and guiding shareholders. And I think, as a shareholder, you want a nice experience. You don't want anything too volatile. So you're more likely to get that with mid-caps as well, but get, massively outperforming market returns relative to other markets at the same time. So it feels like the best of both worlds, really.
I think, very compelling investment case. And staying on the topic of valuation, if we may, as we know, the FTSE 250 is trading at a discount to the FTSE 100. But what do you see as a potential catalyst for a re-rating?
Well, I'll give out a few numbers first, because you can talk about a discount, but then it's, what sort of flavour discount. So let's have a menu here. So do you want a discount on PE? You got that. 11.9 times now versus 12.4 times for the year ahead on PE, and that's mid versus large. On a peg discount of around 20% to the FTSE 100 as well. Would you like a better dividend yield? We can do that too. 4.1% versus 3.7% for FTSE 100. And on price to book value, we can give you maybe 40, 50% off there. So it's about double the price to book for FTSE 100 versus mid caps. So I think you can call that a discount.
It's a comprehensive set of stats. We'll take that.
Absolutely. And as I said before, we have seen a small re-rating in the depths of despair when we were never going to get a trade deal with anyone, all of about maybe 6 weeks ago. You saw the shares of the index as a whole down sort of 11 times. So, we have seen a little bit of the green shoots, a bit more appetite, but certainly more to go. Other catalysts, maybe further trade deals, continued solid GDP readings. We had 0.7% for Q1, and that was, I think, greeted with relief and surprise. Although I think when you look at the more micro data, you can actually see the growth in some areas where, people seem to have an appetite again very much for, say, holidays, for example, that's protected. And certain markets are seeing a return to growth. Some areas of retail sales quite strong. And I think generally the consumer is very important in the UK domestic market. And it's like that service-led market. And the consumer had huge PTSD post-COVID because this huge inflation, the consumer was really beaten up by that. And actually, the consumer is being taught to expect prices to rise and rise and rise over the last few years. But actually, now we're starting to see that there could be some disinflation. So, you might see in July, for example, energy prices coming down. I don't know if you drive a fossil fuel car. Will you be prepared to admit that?
I do. I'm afraid to say sorry.
So what prices come down at the pumps? I think, whether you're driving diesel, I won't ask that, or petrol.
Not any longer, I
Yes.
think is probably the right answer.
But either way, the prices come down significantly. And I think, this is a consumer has been in pain with prices rising constantly. So it's just it's, oh yes, I have another £10 to spend on chocolate after I've bought my petrol or whatever. I don't think we can underestimate, we are a nation of people who like to spend time in their cars, and the petrol price coming down is, really quite helpful. And I wouldn't say it directly leads into outperformance of UK mid caps,
Right.
but I think it's a factor in all seriousness of preserving and increasing the strength and the animal spirits, I think, really as well, the feel good and a bit of decent weather as well. Throw that in there,
Yes.
Simon Wilson's not afraid to call that out for next and say that that's helpful. But, I think we'll take it, whatever it might be.
Absolutely. And staying on the topic of the T word as well, recent stock market volatility has centred around tariffs. So how do you think trade tensions could impact UK mid-caps, not only in terms of the tariffs themselves, but also in terms of the knock-on impact on growth in the UK and globally?
Well, by T word, you mean tariffs. Well, as I mentioned earlier, not one, but two, but three trade deals. So it would seem that UK mid-caps would have the edge on other regions' mid-caps because there's more certainty at present post UK-US trade deal as it was. I mean, it's not a trade agreement. We don't have all the detail. Is still to be worked through, but it is a deal, which is more than many other countries have. So, when we look at UK mid-caps versus other regions, then there's an advantage. And I already talked about some of the valuation advantages versus, say, our own large caps as well. But we do recognise that the 10% tariff level actually is still new and is likely to affect activity in some ways and put some grit in the system. So we can't deny that. But in the less ugly competition, the UK is winning. And there are a few questions, around the impact of likely diversion of Chinese goods into the UK system that might have been destined for the US before, but that obviously depends on how things end up being negotiated between China and the US. So there is an argument around potential prices coming down because Chinese goods get diverted here. But actually, we don't know that at the moment. And I'm just really, really glad that I'm not an economist because I've lost track of the amount of updated forecasts that are flooding in from the various economists who I'm lucky enough to receive research from. But, those economists having to sort of forecast inflation, forecast GDP growth, forecast interest rates. I think what is most interesting, though, is the number that we know. That, even in the Q1, I mentioned 0.7% GDP growth here in the UK, but the bank staff estimate was they think it's actually flat in the UK. So that just shows you that nobody knows. But what we can do is we can pick out individual pockets of growth. And that's the beauty of investing domestically in the UK. We can almost see those pockets of growth. You can almost see what's wearing out in people's homes. And this is a bit of a leading question for later on. But you can see also what people are fed up buying and what they might fancy buying now, and where the money is being directed. So I think for all those reasons, tariffs will put grit in the system, but we have to focus on the niche areas that we know more about because, being an economist is a very tough job at the moment.
It is a very tough job. So moving on to the fund, per the latest fact sheet, you've outperformed the index in annualised share price terms over 1, 3, 5 and 10 years. So could you talk us through some of the drivers of this outperformance and which holdings have been your strongest performers in the last year?
Yeah, well, thank you for pointing that out.
Well,
I think we should probably say that the NAV outperformance has been there over 5 and 10 years. And, it's looking better over 1 year now and year to date as well. So, making the difference between NAV outperformance and share price performance. But I think more recently, the shares in UK equity investment trusts have started to become more interesting for people for reasons I mentioned earlier. So that helps, obviously the share price follows the NAV to a certain extent, but there can be a bit of a lag sometimes. I think the ability to gear up has been helpful over the long term for performance. We've had this trust for nearly 22 years. I haven't been here that whole time, but over the long term, we've looked at it, and in most periods, gearing has been helpful. Not always, but most of the time. So I think it's important to reflect that, because that's why many buyers of investment trusts go for closed-ended rather than open-ended, as you'll know. And of course, there have been certain absolute hero stocks. We talk a lot here about the multi-baggers. In other words, stocks where you make multiples of what you invested in the first place. And the mid caps is full of these kinds of multi-bagger stocks. And I think the classic one probably to mention would be Games Workshop, which I think the shares continue to go up as I speak. And that one, has been an absolute hero in terms of the way it's managed its capital, the way it has preserved its high margins, a truly unique stock, a company with so much IP that it's done a deal with Amazon to go into different media productions and to actually breathe digital life into what started out as a plastic figurines company where you paint the very, very expensive figurines with even more expensive paint. I think it's a truly unique hobby and incredibly addictive as well. And, I think people can see the benefit of playing it or seeing their children play it. And it has returned multiples to shareholders and has been able to reinvest in its own capex. It hasn't issued shares. It hasn't done acquisitions. It actually says it actively is not interested in acquisitions. And this is what we see with many of our multi-baggers. They don't do value destructive acquisitions. Surprise, surprise. But, you can see the opposite. The companies that don't do so well, one feature is value destructive acquisitions. Best way to destroy value, from what I can tell, over the last 25 years, actually. But this is a company that, it has not gone up in a straight line either. And I think you get that with the mid caps, but what they do is they pay dividends to kind of make a bit like investment trusts, to make the hard times better. You still get your dividends, so they make it a bit easier to ignore those times where it's a bit difficult. But this is one holding that has done extremely well for us. And I think more generally, it's the stock picking, as you'd expect me to say, the active management, not trying to play the sectors necessarily, and avoiding the disasters and being ready to sell when we see those maybe accounting issues particularly, or value destructive acquisitions happening, or we see balance sheets getting out of control. So the other half of your question was around what stocks had done well. And I think certainly Babcock is worthy of a mention. It also had a mention in the Sunday Times, I think, or in the weekend press anyway. And that's been an incredible one, really. And I talked about Games Workshop. We would see that as a unique stock with very high margins, with doing something that no other company does. And Babcock's another kind of stock that we tend to buy into. And we call these flex stocks. So our portfolio consists of unique and flex stocks. And often these flex stocks are at a strategic crossroads. And I think that might be putting it politely for Babcock at the stage where we were starting to look into it. Because, I mentioned value destructive acquisitions. Well, there had been a bit of that going on. And it was very interesting. I think, the experience in the team. I work with Andy Brough and James Goodman. And that is, between the two of them, you're looking at maybe 50 years of experience. I'm saying one of them is responsible for more of that than the lion's share. But it's knowing management teams from before. So there's the two Davids who manage Babcock, the CEO, and the finance director. The finance director was at Cobham and was at Kinetic previously, so we knew him from then. And the CEO was also at Cobham, and we knew him from other roles he's had as well as a CEO. And they came in and looked at the financial structure of the company and really strengthened the balance sheet, went after some underperforming contracts, and most importantly, stemmed the bleed of contracts, not signing contracts where you weren't going to make a profit. Because actually it's quite important not to sign contracts where you're not going to make a profit. But I think sometimes, not just in defence, but in other industries as well, the sales team is so keen to sign the deal that they maybe aren't looking closely enough at the parameters for making a profit. And I think that was an issue that Babcock had at the time. It was at a strategic crossroads, and it's managed to start to generate profits consistently on its contracts. And we have the confidence that new contracts that are being signed are profitable. And it does do some unique types of work as well for the UK government. And we are also at the start of a defence growth super cycle, and they're feeding into that. And then you also get the sentiment around defence was the sector nobody wanted to own. Looking back 2 or 3 years ago, you would be asked a lot about, with the theme of ESG, is this a sector you want to own? And that's obviously turned on its head with all that we've seen geopolitically over the last 3-4 years. And now it's seen as a force for good, I think. And, there's a much longer discussion to be had there. But I think that also explains why the stock is re-rated the way it has. So it's gone from an untouchable to getting its face all over the Sunday papers in a good way.
We'll come back to defence stocks in a moment, if we may. You mentioned dividends a moment ago, and one of your recent investor presentations referenced your dividend achieving a compound annual growth rate of 12.6% in the 20 years to 2024, compared to, and I like the comparisons that you used, 3.6% for a pint of beer and 3.4% for annual house prices. I think income seekers often gravitate to the FTSE 100, but what does the FTSE 250 offer in the way of income?
It's not necessarily the FTSE 250 as a whole. It's the kind of companies that we invest in within the mid 250. So we just invest in the ones excluding the investment trusts. So that's about 170 companies at the moment. Probably, given M&A this morning, it was that number. But those companies that we invest in tend to be highly cash generative, and they are able to reinvest in their own growth and also pay dividends and occasionally pay special dividends as well. And that is what investors are seeing the benefit of when they invest in Schroder UK Mid Cap PLC, the tendency to invest in those kinds of companies. And that's why, this is actually a growth-focused investment trust. But because of our style of investing, these companies end up chucking off excess cash, or as Games Workshop would say, truly excess cash, truly surplus, they say, actually, which is an interesting expression. That because, I guess you have to be sure that you're not going to have to come back begging for that cash at a later date. So there are a subset of companies within the mid 250 that are able to pay out significant dividends, and they tend to be very well covered as well, because we get on their case if it isn't. And I think it's that sustainable dividend flow as well. But I think that might surprise a lot of people when they're getting asked for sort of £7 or £8 a pint, that it's only been that sort of inflation over the last 20 years. Yeah, it did me.
So SCP has the highest allocation to defence in the investment trust space. Do you see a potential defence super cycle, and do you think defence stocks are still offering an attractive risk and reward profile given current valuations?
Well, I think there's a piece around sentiment, and I mentioned ESG and, more people willing to hold investments in defence now. So that's an automatic reason for valuations to be higher in defence stocks. I think there's the narrative as well around governments agreeing to spend more, but then actually spending more. And what might be more interesting actually is the picks and shovels end of it. So you've got the obvious ones, and we do own a lot of defence stocks, and we're very positive on companies like Chemring, for example. And I already spoke about Babcock. Kinetic could be interesting because of the most recent trade reset between the UK and the EU. That could be interesting for Kinetic in particular. But I think the picks and shovels angle actually might be the next thing to look at. So Sirius Real Estate, for example, they have industrial property in Germany. And it's all very well that Rheinmetall needs to make more bullets, but where is it going to store them? So management made the interesting point that industrial space is unlikely to continue to have just those sort of double-digit yields to sell at those kind of prices in Germany. I think those yields are bound to come down. In other words, the price of those will go up. And so I think it's more the thinking about the actual logistics next around how you supply, how you cater for that new defence spend. And it can wax and wane, but certainly if you say, is there going to be more spent on defence over the next 5 years in Europe than there was in the previous 5? I think the answer is yes. And it does feel like every second day when I come into the office, there's another new contract signed. Bodycote is another one that supplies into the defence related end of industrials. So I think it's thinking a bit more widely about how to get exposure to that away from the first derivative and into the second derivatives.
And you're also currently overweight consumer discretionary, but what areas are you perhaps avoiding in this space, and why?
Yes. Well, we talked about pints earlier, and I think, there are certain things you can automate. And I did go to a concert in some big football stadium, I don't know, 2 or 3 years ago, and they had automatic pint machines and, serve your own pint. And really the experience wasn't there. So what I'm trying to get at there is, we're not so keen on consumer discretionary sectors where you need a high input of labour. Restaurants, pubs, you still need a high service level in order to do well. And that's just getting more and more expensive. And it could be interesting now. You could end up actually again with the UK-EU agreement. I don't want to say anything too political, but it could be that you are able to get labour for a bit less again now, because perhaps you get more of a supply of the younger kind of worker who comes into those industries. So, watch this space. But I think areas where you can automate more easily might be, fine in consumer discretionary, and also areas where there's a new driver of spend. So, not wanting to lead the witness too much, but, curries is an example of one you were going to ask me about.
I was going to ask you about curry. So you recently added them to the portfolio. Could you talk us through the investment case that you saw for curries?
Yeah. So over the last, 6-9 months, we added a holding in curries. And that was very much an unloved flex stock, seen as a company that had difficulties with its balance sheet, with its pension, had sort of lost its way a little bit, was suffering. Actually, it has quite a big business in the Nordics, was suffering with product being dumped in the Nordic market that was destined for Russia initially, then got dumped in those markets. So really pushed down prices for those electrical products in those markets. So they're like number 1 or 2 in the Nordics, as well as being number 1 here for consumer electricals. And actually, what sort of really sparked my interest was the service level there. Having said that, I wouldn't necessarily invest where high levels of service are required. I was very impressed. There aren't very many places to go now to buy your consumer electricals, So myself and the family popped into Currys. My boys were allowed to sit playing with the gaming kit and nobody bothered them. We played with the Dysons, so I don't know who was having more fun. I think, was it me or the boys? But, it was a very pleasant experience in store, joking aside. So the advantage of investing in your own domestic market. And it was that individual experience, very high level of customer service. The store looked good. We were in there for over an hour. We spent too much money. And I thought, you might have gone to John Lewis for those kind of things in the past. But really, there's very little competition on the high street now if you want to try out a new gadget. And also the ability to return it. It's more of an issue if you bought it on Amazon, returning sort of a large electrical item. So that side of the customer experience, coupled with what I knew about the Nordic market starting to recover, and also just looking around as well at the amount of consumer tech that people bought sort of 4 or 5 years ago when we were all at home, when we all needed a new bread maker and a new light for our webcast where we were being filmed, and we all needed a new laptop and we all needed a new mouse, and all of those things have got a bit grimy and grubby, to be honest, certainly in our house over the last 5 years of, having a toasted cheese sandwich in one hand and the laptop in the other. So I think there's a consumer electricals refresh cycle happening. And also Currys is the number 1 seller of AI-enabled laptops. And that is a thing that has started from a twinkle in someone's eye to something that's actually practical. But there was, a number of angles, and as well as their own mobile virtual network operator, which has well over 1 million subscribers now. So that's another feather in their cap they had too, which I felt was undervalued. So, and also their pension deficit, the pressure from that, I could see that was starting to come off, having dug around that a little bit. So I felt the cash flow profile would start to improve. So that's actually been a successful holding for us thus far. But, maybe the thing to pivot to next will be pubs, will be restaurants. So, I think it's the importance of staying fresh, and, the importance of going out and shopping, or the importance of going to the pub to keep your research fresh.
Yeah, definitely good to get some first-hand due diligence. If we can squeeze in one last question before we finish.
Sure.
How is M&A activity impacting your portfolio? And are you worried about a shrinking investment pool if the hopper isn't being refilled by IPOs?
I think that's a really serious and important question. The de-equitization of financial markets is a theme globally. My US colleagues would say the same. I think that some management teams might say they want to be away from the spotlight. They might say they can get better paid in private equity. But also, I think these things are cyclical as well. And as interest rates start coming down, you can probably expect that at some point you will start seeing more IPOs. Now, we had one IPO in the UK, which was very successful last year, which was Raspberry Pi. Yeah. But you are seeing IPOs in Europe, and you are seeing it just literally over the last month or so starting to pop up, whereas it's quieter in the US. So I think it's whether a market's in fashion as well. But I think as rates come down, you can expect to see some more IPOs as markets start to improve. And, you've got that rating gone from the depths of 11 times to 11.9 times now, steady on for mid 250. As ratings start to improve, maybe you start to see the first couple of IPOs start to emerge. And we did actually have 2 small IPOs announced in the UK market yesterday morning, but in the small cap arena. But you want to see the bigger ones coming through. The M&A itself can be a great sort of sugar rush for the portfolio, because last year the average premium was around 50% for UK companies that were bid for. And 2 in which we had fairly decent holdings were Hargreaves Lansdown, and we also had Britvic. Now, you can argue about whether the premia should have been higher for those, but some smaller companies were bid for in excess of 100% premia. I'm thinking of Acquis, we didn't have that one, but there have been some very, very significant premia paid, and that reminds you of the inherent value remaining. But definitely M&A, when we look at the outperformance of the mid 250 companies are more likely to be acquired than large caps, simply because they're more digestible. And that gives you that bonus sort of in terms of performance. But we wouldn't buy a company because we think it's going to be acquired. We'd buy it because we want to be an investor for the longer term, unless, of course, it hits our sort of fair value very quickly. I think the other important thing to mention, as well as M&A, that's been enhancing portfolio returns is share buybacks, but that also has the same effect of shrinking the pool of equity. So I think it's encouraging to see things like the Mansion House Compact being discussed, certainly for AIM, for example, and in terms of getting more investment into UK shares. We talk about making UK equities great again, a Mukega, which is really trips off the tongue.
Yeah.
But I think actually UK equities are great. I think that's the thing. It's just make more people realise that UK equities are great again, because the growth is there. I mean, the PEG ratio for me is tantalising. And I think the M&A, we will continue to see, private equity gets it. We'll continue to see those bids come through, and especially as trade agreements are then agreed and, financing can be agreed. But I'm not despairing, because I am seeing, those IPOs starting. But, I'm not complacent either. So, I plan to continue to fight for the future of UK equity markets.
Fantastic. That's a very positive note on which to finish. So thank you very much for your time today and some really interesting insights.
My pleasure. And thank you for coming in. Cheers.
And I'd also encourage you to visit the Schroders website to find out more information about the trust, including Jean's insight articles. And if you'd like to read our recent research note on the trust, please head over to the Kepler Trust Intelligence website. And we hope you join us again soon for another edition of Trust Issues.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.